Hey, how's it going, everyone? My name is Amos, and today I wanted to talk to you about one of my most favorite dividend compounders with cheese, also known as McDonald's. By the way, hands down, they have probably the best pound-for-pound breakfast menu out there out of all of the fast food restaurant joints. And at the time of filming this video, McDonald's is currently trading for about $310 a share. If we zoom out and look at their one-year chart, they're pretty much near their 52-week high, meaning for the past 365 days, they're about the most expensive price they have been on the stock market. And the reason why I labeled them a dividend compounder with cheese is, if I zoom out and show you the total gains in the stock market while not considering the dividends, the stock price appreciation alone is 87,000%. My goodness gracious, this is literally the definition of a dividend compounder. And in the context of McDonald's with cheese. By the way, if you cannot tell by the name of this channel, I'm a huge fan of McDonald's. And as a guy that has a six-pack, I eat out at McDonald's once or twice a week. I know it's very funny, the irony, but in today's video, we're going to be talking about their earnings that they just recently posted, the implications from it, and also how they missed the earnings, but still, if you look at it right here, year to date, the stock price is up by 7% in the year of 2025. So I'll talk about why it went up, and then towards the end of the video, I'm going to talk about their intrinsic valuation, meaning how much McDonald's should be worth, and then also a good price to buy into McDonald's if you're thinking about it or if you're sitting on the sidelines. So right off the bat, spoiler alert, what exactly happened with their earnings? Why did they miss? Well, as you can see on your screen right now from this Wall Street Journal article, McDonald's US sales drop as customers spend less. McDonald's revenue disappoints as US sales see worst drops since the pandemic. So when you think about McDonald's domestically, it wasn't very pretty. However, internationally, as you can see by this highlighted third bullet point, it smashed. It did well. I think it carried the team for them not to be all doom and gloom and to have a little bit of prettiness in this earnings report. Anyways, their earnings per share, they met the expectations, $2.83 per share, pretty darn good. The revenue, that's where they missed. They posted $6.3 billion. The expectation was $6.4 billion. So when you think about the miss, it's not exactly the worst picture in the world. All that to say, if the US stores for the past 3 months, if the sales were normal as they usually are, then they would have surpassed the revenue expectations. But we'll talk more about what exactly happened there. When you look at it year over year, I highlighted this because I wanted to call out that for McDonald's, it was pretty much flat. From 2023 to 2024, it barely increased, right? We're talking about $25.4 billion for the full fiscal year to now $25.9 billion. So this is a company that is moving at a very slow rate, but at least it's trending in the right direction. It has a very boring, but a reliable and a stable business model. And I say it all the time. You can't just think of McDonald's as a fast food joint. You also have to think of them as one of the biggest world's real estate company because they own some of the most expensive properties in Paris, New York City, San Francisco. When you see a McDonald's location, they own that property and that store and the brand and the image. And what they do is they rent it back out to their franchisees. Very good business model. You love it. But I get it. It's not as sexy as Nvidia or Google or Amazon that are doing breakthrough technology innovations. But let's dive a little deeper into the earnings report. So they missed in their revenue because in the US, this is crazy. They had an E. coli outbreak from the onions that they used to top off their quarter pounders, and it hit heavily in the Rocky Mountain and Midwest region of the US. It was pretty atrocious. It kind of reminds me of how back in 2015, they also had an E. coli outbreak. Chipotle went through the exact same situation, except they couldn't really pinpoint where the source was coming from. Chipotle's stock price was just absolutely demolished, and the customer base, they were kind of scared and hesitant to walk through the doors of a Chipotle because word on the street at the time was the probability of you getting food poisoning from a burrito, you don't want to play with those odds, right? You don't want to be sitting on a toilet pooping your brains out at work or at school or when you're trying to go to bed at night and you still have to vomit or poop. It's not a very fun game. I had food poisoning twice in my life, and I can tell you it's one of the worst, horrendous feelings ever. To be vomiting nonstop. And what makes it worse is no matter what you put into your mouth because you need some food to sustain life, it comes right back up. It's just a disgusting feeling. The first time I had food poisoning, it was back in high school. I had just got done with a Model UN conference. When I was in high school, I was an overachiever. And then afterwards, my friends and I, we decided to grab some Hawaiian pizza. And I don't know if it was the ham or the pineapples, but I was pooping my brains out for the next 7 days. It was horrific. And then as an adult, a couple of years ago, I had food poisoning from ground turkey meat. And I kid you not, that episode lasted about 8 days, and I lost 10 pounds from diarrhea and vomiting. I'm sorry, I should disclaim in the beginning of the video that it's gonna get a little graphic. But anyways, that is what they went through. So as a result, a lot of the customers based in the US, they were like, okay, first of all, the menu prices, too expensive, as I highlighted right here, but then also there was the E. coli scare. People were like, dude, I don't know if I want to buy McDonald's right now because I don't want to deal with food poisoning during the holiday season. So both of those factors combined led to their revenues dropping. And this wouldn't be a Dividend compounders with cheese video if I didn't dive a little deeper. So I looked into it, and the CDC announced back in mid-December that their E. coli crisis was finally over. And that's because McDonald's severed their ties and partnership with the onion farm, and so they no longer get their onions from that farm. And so the McDonald's leadership team forecasted that they're going to financially recover from this debacle somewhere around the springtime, March or April. They had to spend a ton of money to restore their image, to pay out for the victims, and to throw away thousands of pounds of onions and source and procure thousands of pounds of fresh onions. So it was a really costly thing to happen to McDonald's. And as you can see in the third paragraph, some investors and Wall Street analysts, they expected it to be worse, the results and the outcomes. However, it wasn't as bad as they thought. So that's point number one as to why, even though McDonald's missed their earnings, they still went up in stock price because it was already priced in. They were expecting a lot worse. Case in point, by the way, I don't know why I keep saying that phrase, my bad. Instead of that, I'll say, in reference, if you check out their revenue of $6.3 billion, expectation was $6.4 billion, I think because of that whole E. coli situation, they were expecting this number to be a lot lower, somewhere to be like, I don't know, 5.7 or even $5.6 billion. For them to miss by a little bit, with all of that disaster and doom and setbacks happening, I think the analysts were like, okay, this is not as bad. And not only that, McDonald's confirmed that they're going to open up 2,200 more restaurants all across the world, of which a quarter of that is going to be based in the US. They're trying to expand heavily internationally. And as you can see by this last paragraph that I highlighted, they're saying like right now, consumers are not spending as much money as they usually do when it comes to eating out and fast food. And when it comes to the quick service restaurant and food industry in general, McDonald's is one of those influential and thought leaders and a poster child for how the industry is doing as a whole. Now, as a guy that is invested into Domino's Pizza, Papa John's Pizza, I can tell you this insight from McDonald's is not out of the ordinary or crazy. It is accurate. I think inflation is causing consumers to think twice before eating out and buying a Big Mac on the whim. Okay, so now we understand in the US, the same store sales went down because of the E. coli outbreak and then menu prices being a little too high. But internationally, when you think about the Middle East and Japan, the same store sales went up by 4%. Actually, more accurately, 4.1%. That is beautiful. But when you think about the other international segments, well, then it only went up by 0.1%. And in certain areas like the UK, it went down. However, France, out of all countries in Europe, it finally went from a shrinking same-store sales to now positive, which is a good thing. And a clarifying point that I want to make is, out of that 2,200 restaurants that they're opening, I don't know if I'm a huge fan of their plan to open up 1,000 of those in China. And the reason why I say that is because when you think about the geopolitical tensions that are happening right now with the US and China, especially the semiconductor chips, and US brands that are currently struggling in China, such as Starbucks and Nike, that historically have been crushing it, it makes me hesitate and feel a little uneasy about all those restaurants opening up. Because even as an American, I know that China has their own equivalent brand of McDonald's, and I think the Chinese people prefer that one because it's a lot cheaper. And the name of that chain is Dividend. However, from my understanding of the fast food space, even though there's domestic equivalents to the US version, I think for the most part, the Chinese prefer the American version, such as KFC rather than the Chinese version of KFC. They prefer McDonald's rather than Dividend. But still, I feel a little uncomfortable because when Russia went all haywire and crazy, McDonald's decided to close their operations and leave Russia altogether. So if China decides to do anything crazy in the next year or 2 or 3 years, who is to say that McDonald's won't do the same? And China is a huge market. When you think about it in a population perspective, China has 4 times more people, and that's a huge revenue source that's going to disappear. So to expand heavily into China, I understand because the money is there and the growth is there. But the geopolitical tension, it just, I don't know, as an investor, I just feel a little uneasy. But hopefully my fears and anxieties, they don't come to fruition. And another positive from their earnings report was they are not tone deaf. They realize by jacking up the prices, it's making consumers think twice about spending their money at McDonald's. And that's why they're seeing people frequent. The traffic is still the same, but consumers are choosing to spend less money with each visit. So they're trying to attract more people to come instead of their usuals, and McDonald's has introduced a $5 meal deal. And as you can see on your screen right now, I think it's a pretty good promotion because not only do you get a drink and a burger, but it comes with the fries and the chicken McNuggets. Pretty solid. Because what I'm trying to say is, when a burger meal starts costing like $9.99 or even $12, then you might as well just go eat out at Chili's and buy a burger from them. But that's not the long-term game plan that McDonald's has. They're trying to transition away from being that cheap, affordable option to now being a more premium burger place like Shake Shack or Five Guys. And are they going to be able to execute on that? I don't know. It's going to be hard because they've had this, the golden arches is associated with being cheap and affordable. But the transition from going to that to a more premium luxury burger, I think it's going to take a lot more quarters for them to execute. But in the meantime, throwing a $5 meal deal like this is going to be smart for them to sustain and in order to grow their top line. So I like it. And something else that you should know about McDonald's is that they are the world's biggest distributor of toys, because when you think about the Happy Meal, you know, that's catered towards people that are like 12 and under, you get the small hamburger, small fries, and a small drink, but it also comes with a toy. And it blows my mind because not only are they a real estate monopoly, but they also are the top best in class for toys. It's amazing. And funny enough, whenever my wife and I visit McDonald's, she always ends up getting a Happy Meal, because here in Japan, I don't know about you, where you live, but here in Japan, every McDonald's near my neighborhood or in my surrounding area, completely packed. I think the Japanese look at McDonald's a different way than we do back in the States, because here in Japan, people will go to McDonald's in order to do their work, such as if they are a remote worker, or a group of people will literally just congregate there, eat their meals, and then afterwards order a drink from their McCafe and hang out at McDonald's. McDonald's is a very different experience here in Japan than it is in the US, and I've never seen a completely empty McDonald's. It's always completely packed. The lobby, the drive-thru, and just seeing that, even on an anecdotal level, makes my nipples absolutely bullish on this very boring company. And I guess my original thought was, my wife, whenever we go to McDonald's, she always orders a Happy Meal, because here in Japan, you don't just get some dingy little plastic toy, you actually get pretty good, solid toys or dolls or gadgets that are, I'm not gonna lie, they're pretty sweet. And last but not least, in their earnings report, they also gave some guidance for 2025. They projected that they're going to expect higher margins for them in face of inflation and cost pressures. So when we think about the operating margin, think of it as how much profit they make from their operations. So when you take into account the cost of all the workers, the cost of the burger patties, the buns, the utility bills to keep the lights on, how much profit do they make after the expenses from the operations? And when you think about a stock as a business, the operating margin tells you how efficiently a company turns revenue into operating profit. So you want to see a good, healthy margin. And I'm going to tell you something that's about to blow your mind. So they're expecting the margin to increase, which is a good thing. As of right now, Microsoft, their operating margin is 44.9%. And their net profit is 35%, meaning after paying for everything, the taxes, the operating costs, for every dollar that Microsoft makes, they pocket 35 cents as pure profit. And from their operations, that would be 44 cents. Remember this number right here, 44 cents. McDonald's current operating margin is 44.8%. It is absolutely mind-boggling how efficient and how good of a business McDonald's is. I don't think you truly understand, and they're expecting this number to go even higher in 2025, which made every nipple on Wall Street absolutely bullish towards McDonald's in fiscal year 2025, which means they set the expectation high, and if they miss, it's not going to be a pretty picture. So to sum it up, why did McDonald's stock price go up if they missed their earnings? Because point number one, as we alluded to earlier, it was already priced in. Leading up to this earnings report, McDonald's week after week, they were going on a sell-off. And I mean, they were declining like 1 or 2% every week consistently leading up to the earnings report. And once they reported their earnings, the investors were like, actually, this is not as bad as we thought it would be. So it was already priced in. And then number two, the future and the guidance that they're giving seems to be pretty good. Like, hey, we're going to recover from this E. coli dilemma by springtime. Our margins are going to get higher. We are expecting our revenue and customers to come back to normal. And because things are going so well, we're going to open up 2,200 more stores. If you are a struggling business, could you have the CapEx and the money on hand to grow the business, or would you rather be focused on fixing your operations to increase your margins and to slash your dividends? You would be doing that stuff. But for McDonald's, they're growing. But also, another point as to why McDonald's stock price went up, even though they missed their earnings, this one's really important. The investor sentiment. It's a huge factor. Because when you think about Spotify, year to date, this is just 2025, they're up by 39%. Spotify just reported their earnings, and just like McDonald's, they missed the expectations. However, even though they missed, Spotify shares still went up in the green by 13%. And that's because they're finally profitable. I remember when Uber first became profitable, or Amazon became profitable, the investors were absolutely bullish because now there was a path for free cash flow and for that free cash flow to increase year over year. And as you can see right here, Spotify, they posted earnings of €1.76. The expectation was €1.99. They missed. This is pretty bad. However, what made Wall Street bullish is that they beat on the revenue, the top line, but more importantly, the monthly active users, how many subscribers, how many people are flocking to their platform, it was a lot more than the anticipated number of 664 million. So even though they missed their earnings, their future looks really bright. And that's why when it comes to the stock market, you really can't predict anything, because you will see solid companies that report their earnings and they beat the revenue and the EPS expectations, and they'll still go into the red. And then in cases like Spotify and McDonald's, they'll miss the earnings but still go into the green and their shares will pop. And that's because when you think about it, when you have a very good company, a good brand, and they have a lot of supporters on Wall Street that believe in them and align with their vision that they lay out in their guidance, then the stock is going to be saved by all the people that are just not going to be selling out of it. However, on the other hand, if you have a really solid company, but a lack of supporters and that stock itself is not in the portfolios of a lot of hedge funds or super investors, then if they miss on their earnings, that's usually a death sentence, meaning the company will slide down like 20%, 30% into the red. And that's why I'm saying the investor sentiment is a huge factor in the stock market, because this is a very extreme case. But if a company has a lot of supporters where it's irrational to the point where it's like, why are you investing into them? No matter what happens in their earnings report, the stock is not going to crash because all of the supporters are not going to sell. And that extreme case is something like GameStop. So if you have a lot of supporters and a recognizable brand, that can usually save a company when they go through a bad earnings report. Or if the vision that they lay out is very bullish, that is also the reason why sometimes a stock will go up. And that's why even though McDonald's might not be the most exciting business out there, as an investor, when I think of myself as a business owner of McDonald's, I think it's fundamentally sound. Their financials, everything checks out. Their balance sheet looks good. Their dividend profile is amazing. But more importantly, the investor sentiment surrounding McDonald's, I feel like a lot of the old people, they understand and they see eye to eye with me, the Warren Buffetts of this world. So if there's a little setback coming their way, yes, you might see some emotional overselling, but for the most part, a lot of the investors that believe in McDonald's, they're gonna pile more money into them if and only if their future and their guidance and their forecast is still green and looks promising. So for Spotify, it was their monthly active users going up, and for McDonald's, they're gonna expand and launch 2,200 more stores. Now, with all of that said, in my opinion, what is the fair price and valuation for McDonald's right now? When it comes to McDonald's, I don't really see them as a growth Cinderella story like Carvana or Spotify. Rather, I think of McDonald's as a very mature business that somehow or another always finds a way to grow in light of controversies, boycotts, or even supply chain issues, including the ingredients. They always find a way to grow. So it's a mature company that knows how to thrive in 2025. So by using a dividend discount model, my fair price for McDonald's is around $332 a share. Right now, McDonald's is currently, like $310, depending on when you watch this, it could be like $305 or maybe even $315 a share. So I would argue right now, McDonald's is not a good price to buy in. So if you are on the sidelines or if you're thinking about it, I wouldn't recommend anybody, including myself, to touch or buy McDonald's at this elevated price point. Because at $310 a share and their fair intrinsic valuation is $332, the upside is not really in your favor. Like, yes, there's still some room to go, but it's not exactly the best price. There's other opportunities and better options out there that are currently undervalued, i.e. Pepsi and Google. I think both of those companies are a better deal. So if McDonald's right now is not a good price, then in my opinion, what is a good price to jump in and to start acquiring or dollar cost averaging into McDonald's? Well, for me, I know it sounds weird or stupid, but whenever they go on an unjustified or prolonged sell-off and their share price starts flirting with about $275 a share, I think for me, that's a really solid price point. Because not only do you get a margin of safety baked in, but at that price, it's absolutely undervalued. And from $275 to their intrinsic valuation of $330 a share, there's a lot more upside. So $275 is a pretty good price. And if it ever reaches $250 a share, I'm going to be selling out of some of my other positions in order to gather up the capital to just go balls deep into McDonald's at $250 a share. If it hits $250, I think that's a bargain. Huge, deep freaking discount for a high quality compounder like McDonald's. And I'm not sitting here in front of you today trying to advocate to time the market, but as someone that follows the philosophy of value investing, you want to buy good companies at good prices. You don't necessarily just want to jump in willy-nilly whenever the stock price reaches their newest high. And when it comes to that quote of timing the market, I associate it with, long-term investing. Buying into something today with the thought process of holding it for the next 10 to 20 years. If you're buying into a company, but you can't envision yourself holding it for the next 10 years, you've got no business buying into that company, especially if you label yourself as a value or a long-term investor. If you're buying into a company hoping for a rebound story in the next month or 6 months, dude, you might be very upset. But with a boring business that's as reliable as McDonald's, I think anything under $2.75 is the way to go. And before you think my intrinsic valuation for McDonald's is ridiculous and exaggerative, well then check this out. The median price target from all of the various Wall Street analysts for McDonald's right now is $325 a share. So is my intrinsic valuation price of $330 that ridiculous? I don't think so. And besides, if I had no morals and I was a loser, no matter what the price is, I would be screaming and jumping up and down saying, buy today, before, this is your last chance. I hate those YouTubers. Instead, I'm saying at $3.10, it's not the best deal and I would wait for the price to drop in order to acquire shares. I actually have a moral compass. So me personally, I acquire and dollar cost average into McDonald's whenever they go on a very big dip. So whenever the share price hits like 280, 270, 250, I just keep buying shares here and there. So with that in mind, now that McDonald's is around $310 a share, would I sell my current shares? And my answer to that is absolutely not. McDonald's, in my opinion, I think in the stock market, there's no standardized answer to buy and hold forever. Instead, I think more appropriately, there's companies that you can buy and hold for a very long time, like 20 years or 30 years, and you have to revisit your investment thesis and outlook for that company because the horizon, the business, the operations, their peers, startups, so many things can change. And so if you need to sell out of a company, you should sell out of it. By the way, I made a very thorough video talking about when should you sell out of a stock with profit. Go watch that one if you didn't watch it already. But when it comes to McDonald's, I genuinely think this is a buy and hold for a very long time type of business. Now, I can't predict the future, but I'm going to assume that in 20 to 40 years, people are going to enjoy eating quarter pounders with cheese as much as they do right now. No matter what's sexy or what's trending or what's in or what's out, McDonald's and the burgers are gonna be here to stay. But anyways, I'm gonna go work out now. I hope you enjoyed this video. I love you guys. If you enjoyed it, then please click like. With that, stay safe. I love you. Talk to you next time.